Hello there, this is James and you're watching Tixee Live. In fact, you're watching Tixee Live presents #AskJames. In this episode, we are going to be doing Moving Averages Part 2. And we're going to be doing an introduction into Bollinger Bands. But before I get into all of that, don't forget, these little videos are for educational purposes only, and in no way whatsoever should ever be taken as financial advice. I always suggest you do your own research, do your own due diligence, and of course, know the risks at hand before entering any trade. With that out of the way, let's get started. So indeed, this is the latest episode of #AskJames. Those who are unaware of this series, it's a bit different from the Tixee Live broadcasts I do twice a day, and my watch-alongs I do for big events. These episodes are purely educational based. The idea is you send in a topic of your choice, whatever you wish, and then I would dedicate a whole live episode focused on that topic of your choice, anything educational to do with the markets. Okay, today's topic, like I've already mentioned, is Moving Averages Part 2 and Introduction to Bollinger Bands. Now, thanks go out to two individuals here. First, thanks to Mr. Victor. There we go. Technical issues today for some reason. Yeah, thanks to Mr. Victor, who requested a bit more information on moving averages on a comment left on the RSI episode I did a couple of weeks ago. And again, another thanks to viewer Apple Mojo. So again, big thanks out to those two individuals for their suggestions. And like I say, please keep the suggestions coming. Please keep in the topics you would like to learn and know about. So please keep that coming. Now, moving on to Moving Averages Part 2. For those of you who are new to moving averages, I probably would suggest you watch the moving average video I did about a month ago, I think it was, which is in the series, okay? Because that's the introduction, beginning of moving averages. Moving averages Part 2, I'm going to be moving a little bit further on with that. So I would recommend watching Moving Averages Part 1 first before moving and watching this one. But anyway, those of you who did watch that episode and you are quite new to moving averages, let's continue. Now, in the previous video, I did have slides. Unfortunately, I've got a technical problem, so I couldn't bring it up, hence me being a bit late on today. But anyway, I still remember what I said in the slides anyway, so it's okay. It's okay. So anyway, moving averages, like I mentioned, are extremely popular technical indicator for traders to use because they can be used to indicate the overall trend of an asset, as well as potential support and resistance areas. Okay, as well as that, they can also be used for noticing when a trend is about to reverse or go in a different direction. Now, last episode, I focused on simple moving averages. Today, I'm going to talk a little bit about the other most popular moving average, which is exponential moving average. Okay, and they're similar. Okay, but there's a difference between the two of them, and both have their own advantages and disadvantages. Now, as you know, on the previous episode, the SMA or moving average is calculated by taking a closing price of an asset over a set period of time, say 5 days, okay, adding it up and then dividing them by 5. Okay, and that's how the moving average is calculated. See, I'm getting a bit of, I know I've noticed I'm getting a bit of problems. I'm not sure. I'm having a little bit of technical problems, so bear with me. Hopefully it will stop soon. Is the sound okay, or is it just the visuals? Or is it just the camera going off every now and then? Let me know, okay? If it's the sound or if it's the visuals. Anyway, as I was saying. So yeah, we take the moving average calculated by taking the closing price of an asset over a period of time, say 5 days, or I'd say 5-day moving average, adding them together and divided by 5, and that's how the moving average is calculated. However, here's the thing. With a simple moving average, okay, like I say it takes those 5 days of closing price of an asset, but say day 2, for example, something happens dramatically in the market, and the market suddenly spikes down. Okay, but then after that, day 3, day 4, and day 5 is still steady. So it's steady on day 1. Something happened on day 2, spikes down, and then day 3, day 4, day 5, the market is steady. Okay, and then it's lagging on video both. Okay, well, we're just gonna have to. I'm obviously got an issue here, making my voice sound like electronic, and it's lagging on the video. Okay, well, just bear with us. Well, hopefully it will clear itself up soon. So I do apologize for any technical issues we're having on this. So do bear with me, and hopefully it will clear up. It will clear up soon. Anyway, as I was saying, so because like I said, then day 2, it's obviously spikes lower and then returns to like a steady. The SMA might give you an indication of a different type of trend. Okay, and it might be very, very slow to react. This is why, for example, exponential moving averages are used, because what exponential moving averages do. Thank you. Yeah, bear with me. Hopefully it'll clear up. So hopefully it'll clear up, and you know, it's obviously an internet issue. So hopefully it will clear up anyway. Exponential does something different, okay? Because what exponential does, say same thing. 5 move out 5 days, okay? So we take 5 closing price of the asset over the 5 days, okay? Day 2 is still very, very volatile. Same thing, same scenario, okay? But the difference with the exponential, is that it takes more focus on the most recent trading days. So instead of all 5 trading days, closing price of the asset over the 5 trading days, it focuses more or weights more on the 3rd, 4th, and 5th day. Okay, 3rd, 4th, and 5th day. That way, it basically gives you the impression, or it gives you the information what is happening now more than what is happening in the past. Okay, and what tends to happen is the EMA tends to trade, or tends to in the flow with the asset a lot more closely than, say, the SMA does. Okay, so let me give you an example. Let's do an example on this. Let's pull up the let's have got the sterling here. Okay, so go to our indicators. We're going to put in the EMA in. First of all, we're going to put a simple moving average. Okay, so indicators, trend, then moving average. Okay, let's do let's keep it simple. Let's do 10-day period. Okay, a nice color green with chosen simple. There we go. Okay, now let's put exponential in. Insert indicators, trend, moving average. Keep it 10. Let's change it to a nice dark shaded blue. And this time, where we say MA method, we click on and go exponential. Click OK. Boom. Okay. And as you can see, the exponential seems to react a lot quickly than the SMA does. Okay, the SMA does. Yes, that's very true, Mike. That's very true. It really has. It's crazy trading day yesterday. It really is. Good to see you, by the way. Good to see you. So yes, as you can see, the EMA is reacting a lot quicker to the current market's movements than the SMA is. The SMA is a little bit behind. It's a little bit slower. And the reason for that, of course, obviously, like I said, the EMA focuses more on what's happened recently to what previously has happened. Now, there is the ongoing debate, obviously, which is better, EMA or SMA? So it's always there's benefits to both. Same as there's disadvantages to both. Okay. Now let's do the EMA advantage first. Exponential moving average. EMA moves closer to the price, as we can see. Is closer than the 10 as the simple moving average, a lot closer to the price. And so as it's closer to the price, if you're trying to catch a trend early or a trend reversal early, it's a good idea, or potentially a good idea, to use a short M&A, like a 10-day moving average on, say, like a 1-hour chart, 4-hour chart, okay? Because it might prove to be a slightly more accurate, or gives you a quicker indication of a change in trend than the SMA does. However, disadvantages of the EMA is that the EMA responds so quickly, it might indicate to you a new trend is forming when in fact it's only a spike in the market. So sometimes it gives you maybe the indication that a trend is changing when it's not, far too soon, because it's reacting to the prices. Whereas the SMA, we already know the disadvantages. We've discussed that, but the advantage of the SMA is as it is slower to respond to the market, or slower to respond, it actually represents more of an overall, gives you a better overall view of the trend. Okay, it's not so erratic like the EMA is. It gives you a better overall view of the trend. And like I say, as SMA tends to be better on longer time frames, like 4 hours daily, and obviously longer periods of time, so longer, like 20, 200, 500-day moving averages. That's why the SMA comes in handy there. So in short, again, this is not, it's entirely up to you. It's all about your own trading style. EMA tends to be better used for shorter time frames, and SMAs tend to be used a lot more for longer time frames. But again, that's all really down to you. Now, the next thing I want to discuss about with moving averages is moving average ribbons. And for this bit, I'm going to be making some very, very pretty picture on my chart in a minute. Okay. Now, MA ribbons, okay, are basically a number of moving averages, all with different time periods, plotted on a chart, or at the same time. Okay. Now, the question often being asked is, how many do we need to use? How many MA ribbons do we use? Now, again, it's down to your personal preference. Some people can use 6 and 8. Some people I know have used 16 to 24 moving averages, which I think is far too extreme in my personal opinion, because as I've said on previous videos before, obviously, if the charts can get a bit too noisy for you to see stuff. Now, I'll show you how we do this. Okay, let's do an example. Like I say, how many you use all really depends on you. But let's do an example. Let's do a 6. We'll use simple moving average this time. 6 simple moving average ribbon. Okay, so let's put that in together. Right, so let's get rid of these two first. Right, so, okay, let's go to indicator first. Indicators, trend, moving averages. Use my calculator figure. So we're going to do 10, 20, 30, 50, 40, 50, and 60. Okay, so we go 10, that's going to be blue. And then we're going to go indicators, trend, moving averages. We do 20 now. And this time, let's choose a nice color, red. So we put the red in. Now we're going to put another one in, indicators, trend, moving averages. And then we're going to go 30, wasn't it? 30. And we're going to do, let's do a nice, don't want to match the candle. So we do maybe a green color this time. So it's 30. Now we're going to put another one in, indicators, trend, moving averages. Then we're going to go 40, and we'll choose a nice color, purple, the color purple. And then we're going to go insert indicators, trend, moving averages. And we're going to go for, what number is it now? 40, 50. 50, and in we go there. 50, oops, I've done that one wrong. Need to put a different color into it. Indicator, trend, moving averages, 50. This time we're going to choose, let's choose yellow in. There we go. Nice pretty picture now, haven't we? And then go insert, indicators, trend, moving averages, the final one, 60. And we're going to go, we'll go for a nice, there we go, that color, brown. Okay, there we go. Almost like the colors of the rainbow. Okay, colors of the rainbow. Now, that's how we put it in. And why do people use moving averages ribbons? Why do they use it? Well, there's for several reasons, because they can give you they're used to give you several indications. Okay, like I say, sometimes I think they can be quite visually dominating. That's why you should never, in my opinion, use too many. If you use ribbons, just tend to use ribbons. Okay, but like I say, they are used to sort of show several things. First of all, it's what's known as expansion. Now, this is, and I'll show you and give you illustrate examples for you in a minute. We'll go and find some. This is when the MAs start getting wide apart of each other. wide apart of each other. And this indicates that the trend is about to come to an end. Okay. Then what you have contraction. This is when the MAs, I mean, all 6 MAs, like we're using now, they start getting closer to each other. Closer to each other. And this indicates, okay, a potential trend change is about to happen. Then you have, and like I said, yeah, the trend change is about to happen. Obviously, you start seeing the shorter ones get together, and then you see the wider ones, the longer ones start to get together, get close. Okay, and then of course you have parallel. This is when they're running in unison, pretty much close to each other like this. And this indicates that the trend you're currently looking at is indeed very, very strong. So let's have a look at some examples. Let's see what we're looking at. Give me a second and pull my chart up as well. Aha, here we go. This is a good example. Here we go. Now, this is the sterling again. This is on a 4-hour chart. A 4-hour chart. Okay. So, as you can see, all right. Currently, if we pull that a bit longer, a bit more as well, so we can see it a little bit clearer. There we go. There we go. First of all, remember what I said. If they get back together, if they get to contraction, means a potential a change in trend. Okay, and as you can see here, okay, the ribbons start getting closer together. What happened? We had a slight change in trend. Then again, we got closer together again. And then we did indeed have a change in trend. Here, as we can see, obviously, when at this point the sterling was on a very, very bad downtrend, the bands got close together again. Actually ran in parallel. You see they're in parallel here, indicating a very, 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 very strong downtrend. Then they started again to expand, starting to widen, indicating that the downtrend was beginning to end. Or run out of steam. Then again, of course, they got together again, close together, contracted again, indicating a change in direction once again. And indeed, the market started to move upwards. You see? So that's why people use ribbons. Again, like I said, I tend to use simple and exponential. You can use either, to be honest. It's up to your personal preference, but I always look at slightly longer time frames, 4-hour and daily, to use the ribbons. But that's how you use the ribbons on that. If we have a look at another asset as well. Here we go. This is interesting. Okay, here we go again. Right. So again, getting closer together. Okay, changing direction. Indeed, we had a change in direction. Widened apart means the direction the trend had run out of steam. Then close together again means a change in direction. Ran parallel with each other. Strong downtrend. Again, started to widen and closed up again, closer together, indicating a change in trend. Indeed, it changed in trend to up here. They start to separate again, meaning the trend was beginning to finish. It then narrowed again, indicating a downtrend. When running parallel again, meaning strong downtrend, and so on and so on. So that's how we can look at it. That's how you look at moving average ribbons. Now, let's move on to the other topic. Like I say, there is a lot more stuff with moving averages, and I probably will do a part 3. Like I said, don't forget these little episodes. These little episodes are only like bite-sized pieces of the market. Okay, I will be doing in the future a new series going to be called Trading School at some point, and it will be a lot more in-depth educational webinar on it. These are little bite-sized pieces just to go over the information, quite simple and easy. Absolutely, of course you can. Yes, you can. You can, use it across any asset you wish. Because, like I say, at the end of the day, all they are doing is calculating the closing price of an asset over a period of time and dividing it by that period of time. So all assets have closing prices. So yeah, good question, but yes, you can. Yes, you can. Good question. By the way, is it a bit better now, the video quality? Is it still lagging? We're still having sound issues? Am I still sounding like a robot? Like a Terminator? Or is it okay? Are we okay? Just let me know. We're okie dokie. Please let me know. Make sure hopefully it's cleared up a bit now. It's not sort of lagging now. Anyway, let's move on to the next part of this video. Like I said, don't forget we do a bigger webinars in the future, and I probably most likely will do part 3, moving averages, again at some point. But today I want to just do a brief introduction into Bollinger Bands. Let's have a look. A little bit the same, but not as bad. But I still sound like a robot, though. White luck. No. Okay, at least a little bit, but it's still must be. I do apologize, ladies and gents, for the technical issues we're having today. Must clearly be maybe an internet thing. But anyway, as we always say, the show must go on, as we always say in the industry. Okay, so I want to do an introduction to Bollinger Bands. Oh, there's another question. Yes, indeed. Anyway, so introduction to Bollinger Bands. The Bollinger Bands, okay, was invented by an individual called, wait for it, John Bollinger in the 1980s. And Bollinger Bands are used to measure the volatility of an asset or the market, and also to identify potential changes in any potential breakouts and potential areas of resistance and support. Okay. Now they consist of 3 bands: the upper band, lower band, and the middle band. The middle band is in fact a moving average. Okay. So there are several ways of. Is it possible to trade with only 2 moving averages? It's absolutely. Again, like I say, trading is personal. I mean, you can use, for example, when you tend to, if you want to use 2 moving averages, you can use 2 moving averages to indicate maybe a trend reversal. I cut that in the moving averages part 1, and the trend reversal or early indicator. How you use it is you put in, say, a longer moving average, say 50, and then a shorter moving average, say like 20. And you see if the faster moving average, the 20, passes below the 50, then that indicates a possible change of direction to the downwards. If the 20 moves above 50, then it indicates a potential change of direction to the upside. So by all means, you certainly can use 2. Again, to your own preference, to whatever you wish to say it to. So yes, you can certainly. Good question. Thank you. So anyway, yeah, by John Bollinger, and it measures volatility and potentially, like I say, maybe 3 bands, and can potentially give you indication of resistance and support levels. Now, there's a couple of trading uses with Bollinger Bands. First is the bounce. People trade the bounce, or try to trade the bounce when the market is ranging, ranging between 2 levels. Okay. The other one is known as the squeeze. Okay. This is when all of a sudden the bands will be really tight, like ranging, and all of a sudden something breaks up and the bands suddenly expand like this. Okay. And that means a change, that means a trend is broken out. Okay. So some people trade the squeeze. The squeeze often indicates a big trend, like a strong uptrend or strong downtrend, because the rule of thumb is the bands are low together. Let me move my mic so I can illustrate it a bit better. Again, I did have it on slides, but I can't upload it. If the bands are close together, it means the volatility is not so extreme. So that's why you can then range it. You can trade between the 2 levels. The upper band being a potential resistance, the lower band being a potential support. If the bands suddenly do this, widen like that means there's a huge volatility in the market. So the market's either going to go on a extreme uptrend or a extreme downtrend. So when the bands are wide, a lot of volatility. When the bands are close together, then we're actually not so high volatility, and we're looking at a potential ranging market. So this is when you're doing the bounce. You've always got to look out for the squeeze as well. So bear that in mind. Let's do an example of that. Give me a second while I get rid of all my moving averages. Delete, so we can see a clearer picture. Delete. There you go. We delete them all. Yay. Okay, so let's do again. We'll keep this to the euro. Let's do the euro because this should be interesting. We do it on a 30-minute. Let's go. So insert, indicators, trend, and Bollinger Bands. And we'll keep it a nice shade of blue. Okay, nice shade of blue. 20 is the sort of standard one they tend to use Bollinger Bands. So go to 20, click OK, and we're in. And we're in. Okay, so we take the bounce. We take the bounce when the market is ranging. Okay, and remember the upper band acts as potential support, and the lower band acts as a potential resistance. Don't forget as well as that, the line in the middle band here, that's the moving average. So if it's above that, it means going higher up to test the upper band. If it's below that, it means obviously it's on a slight downtrend, so it's going to test the lower band. Okay, so as we can see, the bands are pretty tight together here. So again, it touches the lower band, acts as a support, the market buys in. Okay, and then obviously it touches the top band. It touches the top band and it acts as a resistance, trends down again, touches the bottom band, acts as a support and bounces up again. But this time it's the MA in the middle acting as a resistance, bounces back down again. Hits the bottom band, acts as a potential support. Now, squeeze. The squeeze is when we have a big change in dramatic change in direction. When you see a candle actually pops above it. Have I stopped? Can you see me okay? Okay, stopped above it. So if we have a look at the sterling, it's a good indication of the sterling, for example. Okay, so this is what happens. When the bands get really narrow, so we're in a ranging market like this, and all of a sudden, okay, it gets so compacted together, something breaks out, something happens in the market, and you see candles break the upper band, and then the bands get wider like this. That is an indication of a change in direction and an uptrend. It means huge volatility. As you can see, we're very, very tightly in a range here. Very in a tight range, trading between two levels. Suddenly breaks above it, and boom. Now the band's gone wider, and we change direction totally to an uptrend at that point. Again, so let's have a look at another example. Let's look at Bitcoin, for example. Look at Bitcoin. Okay. Let's have a look at Bitcoin. Here we go. So yeah, there we go. Very tight. Bounce, breaks below, bands get wide, change the direction, market goes on the downtrend. Tight, bouncing, breaks below, there's the squeeze, and the market goes down into the downtrend. And then the bands get wider, indicating huge volatility. So that's how, people tend to try and use Bollinger Bands there. Is there any questions at all? Any questions? Or is there any suggestions? Any suggestions for another topic you want me to do next time? Okay, not a problem. Not a problem at all. I mean, I do apologize for this episode with all the technical issues we've had today. I hope it's a little bit better. It wasn't too off-putting. And for those of you who put up with it and stayed with me for the last 30 minutes, even though we keep cutting out and I sound like a Terminator, I really, really appreciate it. I really do. Yeah, I really, really do. Like I say, if you do have an idea for a topic or something you want me to cover next time, you can, if you can't think of it now, not a problem. You can put it in the comment section, either on YouTube or Facebook, and I will see it, of course, and we will do an episode. Like Mr. Victor today, not today, 2 weeks ago, it was his suggestion to do, it was his suggestion or his request to do a little bit more moving averages. That's why I did moving averages today, as the second part of moving averages. And a viewer called Apple Mojo, he said, can we do something on Bollinger Bands? So this is why we did the Bollinger Bands as well. So yeah, okie dokie. I hope you put up with it. I hope you found it useful. Anyway, despite the technical issues we've had today, which is very frustrating. I do appreciate your patience with that. I really, really do. But anyway, if there is no questions, I'll be back online again later today in just under an hour's time to do the US session. Hopefully we won't have any technical issues then either, so we can get that sorted. I'll have to double check, see what the issue is. So hopefully we'll be all right for that. And this can obviously some breaking news stories which have happened in the last couple of hours. So that's going to be something seriously worth talking about. So we're going to have to be looking at that and the implications of these events on the market. So please don't join me. Oh, and we've got earnings season as well. So It should be quite an interesting little program. Anywho, if there is no questions, not to worry. Don't forget, if you've if you're watching me on Facebook and you enjoy this episode, always give us a follow. If you're watching me on YouTube and you enjoy this video, subscribe if you like. Hit the notification button so you know next time when we're going live. If you enjoyed this video and you put up with me and you put up with all the technical issues we're facing today, I'm really grateful that you have. Give me one of those. It's nice to know that you like what I do. Anywho, till next time, don't forget, these little videos are for educational purposes only, and in no way whatsoever should ever be taken as financial advice. I always suggest you do your own research, do your own due diligence, and of course, know the risks at hand before entering any trade. Thanks very much. You're welcome. Know the risks at hand before entering any trade. Till next time, every single one of you, trade safe.